Hello everyone and welcome once again to the weekend review and look ahead. I am Will Hassel. I'm going to be using the TradeMonster platform here. My account still hasn't been rolled over, so pretty much these last 2 weeks I've had to sit on my hands and watch my my portfolio kind of just get crushed. There were a lot of moves that I wanted to make throughout these last 2 weeks, but I was unable to. Currently got our chart of the Dow up. I can do multiple windows, but I'm just going to roll with this one window just for a streamlined view for everyone. Still got my normal indicators up here. As we see, we got the 50 move in red. We have the 50-day moving average, in the blue the 200, and in the yellow the 21. This is a 5-day 30-minute chart of the Dow Jones Industrial Average. We had some tough trading these past 2 weeks. Let me go and bring this out to a 2-week chart here. Really we came off those highs and we've just been going straight down. Really because of the sell-off and what I don't consider tech names a whole lot. I consider more along the lines of the high multiple stocks, because stocks like Under Armour, Michael Kors, Starbucks have been getting slammed too, which, as you know, I am all long. But they aren't really tech names, they're just high multiple. Chipotle got slammed as well. So it's not necessarily just tech names. When you look at the Wall Street Journal, Barron's, whatever, and they say the tech, crash. Now, the Nasdaq has been hit a lot more than the going to the Nasdaq here. Nasdaq chart has been hit a whole lot more than the other indexes. As you see, close way below all of its moving averages. And as we go to the 10-day chart, really a lot of selling off. It's because it had a whole lot of high flying sectors like biotech, and it had stuff like biotech and Tesla and some of these tech companies that do have very high multiples, but just all in general, a lot of stocks that did have high multiples, which is what you got to be careful about, especially in this environment. As you see, Nasdaq just way below all of its moving averages for that week, for that 2-week chart. And here's the 2-week chart for that for the S&P 500 index. Below all of its simple moving averages again. Topped out up here at 1891. 1897, almost reached 1900, but then the kind of selling off hit, and a lot of stuff just started plummeting. Whatever really had a high multiple, because high multiple worked last year, but this year doesn't look like it's happening. Going on into what we've got going on this next week, a lot of, to me, what seems like crucial data. On Monday, we have March retail sales coming out. The estimate is spot 8% increase versus last period of a spot 3% increase. Also on Monday, we have February business inventories. We were looking for a spot 5% increase as opposed to the last period of a spot 4% increase. On Tuesday, we have the March CPI data. We were looking for a spot 1% increase. It will be the same as last period's spot 1% increase. Going on to Wednesday, we have March housing starts. We were looking for 970,000 starts versus last period of 907 starts. March industrial production, we were looking for spot 5% increase versus last period of spot 6% increase. And also on Wednesday, we have March capacity utilization numbers. We are looking for 78.8% as opposed to last period of 78.4% increase. Then Thursday, we have the Philadelphia Fed survey. We're looking for 10 versus last period of 9. Also some other news that's going to be going around. We're going to want to keep our eyes on Ukraine, because that is still a thing, even though the markets don't seem to be too interested in it anymore. We are also looking for, on Monday, all those long Under Armour, including myself, they will be doing a split 2-for-1 because I actually kind of like this because it takes away the high price tag to it and almost gives you a little bit more extra leverage when it comes into earnings season. I'll actually bring up a chart of Under Armour because I will start diving into my positions and how they fare. Here's Under Armour over the past week. And then on Tuesday we have Fed Chair Janet Yellen speaks via video conference at the Federal Reserve Bank of Atlanta 2014 Financial Markets Conference. Atlanta Fed President Dennis Lockhart makes opening remarks. Janet Yellen is going to be doing a lot of speaking this week on Wednesday too, and on not on Thursday, but just Wednesday and Tuesday, you may want to go and pay some attention to that. She may make some remarks that may generate some news, but I just kind of pay attention to those remarks just in case she does say something that does get the market's attention. Also on Wednesday we have the Fed releasing their beige book. That's going to be a key market mover that day, and also the ECB Governing Council meets in Frankfurt. We want to keep an eye on the ECB as they start thinking about doing possible QE into this next year. So that's something that we're going to watch because their QE may involve buying U.S. Treasuries. Yes, I know it does seem like we just got rid of our own QE or dramatically lowering it, but here we go again. And then also on Wednesday, like I said, big market day for Wednesday in terms of data. China releases their first quarter GDP data. That's actually going to be on Tuesday night, Wednesday, Chinese time or whatever time zone they are in. That's going to be a huge one. It's really going to affect trading on Wednesday because China is the second world's largest economy, and there's been murmurs, whispers through the PMI data, through other people talking that the Chinese that a lot of fears going around that China may be slowing, and it is an industrial powerhouse, and we certainly don't want that happening. So I think if we see a bad print in Chinese GDP, we can see one of two things. The first one being the most logical one, that would be we see a sell-off again in the markets for the U.S. because we don't want China slowing down because they are an industrial powerhouse. And then the second one, which is the least likely of the two, is that people kind of flood to the markets that are working. United States to an extent. I think we may get some of that, a little, maybe a pop or something like that, because people may be flooding into our markets just because it seems like we're in a better position than China. But I think that's the least likely. I think the first one of a sell-off because of fears of China slowing down, or the realization that China is slowing down, is probably the more likely scenario. Moving on into Under Armour. Split Monday 2-for-1, so you'll get shares that are about $51 a piece. I have currently 5 shares, so I'll get 10 shares at $51 a piece. In terms of the support, I actually don't really want to go over the chart right now because it'll all change as soon as the split goes. So I just kind of brought up the chart just to show you what's been going on. It had been using that 102 level as support. Once it breached 104, that was kind of the range that it was in terms of support. But now it's kind of broken all that. Going on into the hedge ETF, which I have been liking. It's above 13, which to me is always kind of an interesting sign when it breaks 13, because that tells me that a lot of stuff is moving in the markets and that we're getting these kind of sharp downturns. As you can see, it's above all of its simple moving averages. I do really, really like this, as this is about 20% of my portfolio is hedged to the downside and actively trading. It does actively trade certain names. It'll only give me time and sales. It won't even give me the portfolio. But it has a large number of the high multiple names like DDD. It has IBM shorting it, which hasn't been very good for them recently, but still kind of works in my opinion, because IBM, as soon as we get all this stuff done, as soon as like all this kind of like tech hysteria goes away, it's going to go down. Starbucks has been hit very recently, breaking below 70, which has been key for a while, going out into 6 months. We see here 70 has been almost like a floor, and it normally pops above it, but failed to break above it past there. I really like a lot of the names in my portfolio here down at these levels, especially Starbucks. My God, it's such. I think they're going to blow away earnings a lot. You got to remember also why I'm holding a lot of these names too, besides not just cutting them, like Michael Kors, Starbucks, and Under Armour, is that they have earnings very closely. Starbucks has earnings on 24th of this month. Under Armour has earnings actually tomorrow. So, you know, we're going to see the stock split, we're going to see earnings. You know, it could move a whole bunch of different ways. You know, and I do think that they will beat on earnings due to cold weather, gear, and just probably some more brand awareness and hype about their brand because of the Olympics. I'm going to keep going. I'm going to go do Michael Kors. See, it's been getting hammered recently. Broke below 90. A lot of talk about maybe possibly filling in this gap here. I don't think that'll happen, especially with earnings this close and it being so strong fundamentally. I mean, it has here. Let's go to the fundamentals, shall we? It has an A grading on Trade Monster. Financials get an A+. Earnings track record gets an A. How expensive is the stock? It gets an F because it has a 29. It basically has a 30 PE ratio, but compared to the industry, it's higher by 69%, 26%. Compared to the sector, higher than 29%, and compared to the S&P, it's over 19%. Price to tangible book about 11. Price to book 10. This is all based off of the most recent quarter. But I do think that you got to remember that this company is still growing a lot, as in not even in Europe. I mean, not even in Asia. It's like it just gets my mouth watering just thinking about the growth that this company has. And also they have no debt whatsoever on their balance sheet, and it's very hard to find companies these days that don't have any debt, because a lot of companies are taking debt out in order to go and pay dividends. Although Michael Kors doesn't have a dividend, I'd much rather see no dividend and zero debt on their balance sheet than taking out $300 million in debt just to go and fund a dividend. What other stocks? Oh, AIG and JPM and Visa. AIG been holding up recently. Not too bad actually, right around 50. Although it did reach a high of 51.80. I have to say I'm gonna probably trade this one out of earnings. It releases on the 28th. What really happens is there's a ramp up into earnings, and then they are fade based off of the comments that come after earnings. So not a whole lot of news also out about AIG. JPM, I mean, I'm just going to be frank, a quarter that I didn't necessarily like, but it does give a bellwether into what a lot of the other banks are going to be releasing in terms of earnings, like Bank of America, Goldman, stuff like that. Weak trading revenues, the low interest rate environment has really been kind of hurting them. Don't want to do any of that stuff. But I still like it. Still pretty cheap, and tangible book and management team is fantastic. So I actually think it's a better buy here than it was last week when it was up at 61. I have to say I really do like it coming off of earnings. Quarter wasn't that good, but I think probably next quarter is going to be better. Still coming off some of these litigation stuff. Wells Fargo did have better earnings, but I don't necessarily like Wells Fargo as much. So yeah, that's JP Morgan. And then a stock that I'm beginning not to care too much about is Visa. They have earnings coming out on the 28th, same as AIG, but I have to really tell you about what my plans were for really when I started seeing some pain. I really wanted to dump all of my QQQ, which is the ETF for the NASDAQ, which is normally how I begin with the weighting of my portfolio, the core of my portfolio. And I also wanted to dump Visa because I did have a profit. Back when it started all this stuff around 216, 210, before it had these massive downturns. I mean, if I would have had the account open, I would have done that, and I would have dumped it all into this company right here, CIM, Chimera Investment Corp REIT. It is a REIT. It is a real estate index trust. I love it. I don't care about earnings. I don't care about how cheap it is. You know what I do care about? This right here. Dividend yield is 21.3%. That's what I really like about it. Dividend growth. I mean, I just want to stick that basically $500 or so in it. The $500 I would have had in you gotta love the 21% dividend. I mean, I'd probably hold it for a quarter because that's just I wouldn't care if the stock moved up or down. I just wanted to get that 20% growth in my cash. I mean, it's a cheap stock, so I'd have to put a lot of it in there. But I think right now what you want is you want the XLU, which is the utility sector. Been doing pretty well. You want stuff that really gives you a yield. That's why I want to put it in Chimera. Here's Southern Company. They have I think it's a 5% dividend. Go and check. This is what I also love about about 5% dividend, but I wouldn't hold these for too long. I just want to collect the dividend, just put it in something that I know my cash will appreciate in, rather than start sliding like Visa or the NASDAQ. It is a little bit more defensive, I have to say, but I really do like that strategy of just putting your money in there for this while, wait for stuff to ride all out. You're still making a lot of money based off of just the dividend yield if you hold it for the quarter. But I mean, that's what I was going to do. I started getting really antsy. I couldn't trade because I was sitting on my hands and knees. Because if I would have attempted to trade, I would have messed up some of the account transfer stuff, because I'm doing a full asset transfer. So all my stocks and stuff should be, transferred into this account. Here's the chart of the VIX. The one that I've been watching a lot, the volatility index. If we get up to 20, that's normally where that's when red flags start to hit for a lot of people. I'm just going to go and blow out just a year chart. We see these massive spikes, like in June when the Fed announced that it would be cutting, QE. We saw this massive spike here all along 20. February into January, that was Crimea. Here was the possible default. Don't know exactly what that one is. But we see these big spikes when really volatile things happen, and it's all normally around 20 on the VIX is when you need to start really watching out for that stuff. Around 18 is when you start getting concerned. I have to say though, in my paper trading account, I do like TradeMonster because they do give me a paper trading account. I've been doing pretty crappy, as you can see. But one of the things that I did do is I bought a while ago, I bought the May 14th expiration, 15 calls for the VIX. That worked out really well, as you can see. In here I've got Chimera in there, XLU, I'm just messing around with options a little bit. Obviously Tesla calls stupid, but I had those on before this whole thing happened. Been messing around with options just a little bit, just experimenting with them. Probably not going to use them too much, but I like having the paper money so I can mess around with them. VIX options, great way to hedge out portfolios. There's been a lot of talk on CNBC and all those places about large trades in the VIX options. It's because that's mainly portfolio managers trying to hedge their portfolio against the S&P. And I think with all this talk, I think I'm going to have to end it here, guys. Thank you once again for watching my videos. Follow me on Twitter. Follow me on StockTwits. Reading my blog. I do love answering questions. That is one of my favorite things to do. So if you have questions, please shoot them over to me. I am at Will Hassel WS. And also please follow along with all the other members of the Leaders Investment Club. All of them are really smart guys. Great ideas that come out of them, and I really taken some of their knowledge. I know I do. Ben Banks has been on fire recently with some of his calls that he's been doing on the swing side. Well, he is a swing trader. Just thank you once again for watching. I'll see you next time.